Hello everyone and welcome back to another video. So recently I just found a video of Ray Dalio talking about some advice that he is giving to investors. Now, for those of you who may not know, Ray Dalio is said to be one of the best macro investors in the world. And a lot of what he was predicting last year in 2020 has actually come true. Like, he has been preaching that high inflation is going to hit us, and now we are currently living in that. So I think that it is really cool to pay attention to what Ray Dalio has to say and really just what he is seeing in the global economy. So with that being said, we are going to be discussing the video first, and I'm just going to put on my headphones and let's listen to this video really quickly. Again, it's only about 2 minutes and then we will discuss it afterwards. All right, so here we go. Let's play the video.
Ray, in terms of just bottom lining it, for those in the audience this morning that beyond thinking about buying your book are thinking about whether they should be invested in the market, putting more money in the market, and I'm thinking about equities right now, taking money out of the market, how do you value this market today?
I think that just the way you said it is going to be a fool's journey. To say, here's the stock market, and I'm going to time the movement into the market. I'm going to time the movement out of the market. Okay, you know what that means? Okay, you're going to guess what the next variant move is and what the next other thing is. A lot of things depend on a lot of other things, and the world and everything readjusts. What has to happen, I think, is investors, most importantly, have to realize two things. First, that cash is not a safe investment, is not a safe place, because it will be taxed by inflation. There will not be an interest rate that will anywhere near compensate. And it seems good because it's not volatile, but you're paying a tax of a few percent a year on that. So A, stay out of that. And then B, know how to balance a portfolio, because the way portfolios work, it's almost like for some part, something happens, another thing happens. In other words, what you can see in the markets today is that, let's say, when equities go down because growth expectations falter and there's a greater likelihood of easing, then you see the bond market go up. And when you see other markets, gold, you're seeing. Watch the market action on every day, and you could see those relationships. But wealth is not destroyed as much as it is transferred. And if you know how to balance those investments, we do it in what we call an all-weather portfolio. But if you know how to balance those investments, that's the most important thing. Be in a safe, well-balanced portfolio. You can reduce your risk without reducing your return. And you will not market time this, because even if you were a great market timer, the things that are happening can change the world, so it changes what should be priced into the markets.
Hey, Ray, one of the things you do write about is China.
All right, now the first thing that Ray starts off by saying is that trying to time the market is a fool's game. He's basically saying that no one's going to time the next move down or really knows when the next move up is coming. And I thought that this was kind of funny because the CNBC news guy, I don't know his name, he was just like, what do you think about the valuations in the market right now? And Ray was just like, that's a fool's question, basically. He was just like, you're not going to time, when to get into the market and when to get out of the market with so many factors around the global economy right now. And it's just a fool's game. No one's going to do it. Don't even bother trying. And that was basically Ray's response. Now, what's also interesting is that historically, market crashing events come out of left field. No one is really expecting them when they happen. And think about it. If we were all expecting, and if we all knew when or what was going to cause the next market crash, we would all just be selling in anticipation of it. Or, so the market crash would just be happening. So it really doesn't even make sense. If we could see a market crash coming, then the market would just crash. So basically, if we can't see a market crash coming, then it's just a fool's game once again to try and time a market crash, because the next one that comes is probably going to be something like all of the other ones where something just hits us out of left field. We don't see it coming, like COVID. In Q3 2019, no one even knew COVID was going to become a thing, and it's completely changed our world. It completely tanked the market in 2020, and we're still living with the repercussions of that today. But midway through 2019, no one on the planet could have predicted that that was going to come or that that was going to happen. So yeah, again, Ray is just saying that trying to time the market and trying to go in and out of the market like this is just a fool's game. It's going to be stressful. It's not worth it. And for me, as a long-term investor, I love hearing this because I like to just stay invested for the long term. And I just like to focus on the next 10, 15, 20, 30 years. So I like that. Thank you, Ray Dalio. So the next point here that he makes, the next major point, is that cash is not a safe investment right now. He says that it is an attractive investment, because it's not volatile. So when you have cash in your savings account, it's not fluctuating up and down like, your stocks are, especially recently. I mean, my portfolio has been pretty volatile recently, but Ray is just saying that interest rates on banks are just too low. They're just too low. You don't see it, but your money is actually losing value to inflation. He calls this the inflation tax. And inflation is at a 39-year high right now. It was at 6.8% in November. So our cash sitting in a bank account getting essentially no interest is losing value at 6.8% a year right now. You don't see it. You're not going to see it. It's an invisible tax, but you're not going to be able to have as much buying power with your cash sitting in, just a savings account getting less than like 1% interest. So Ray is really preaching to everyone. Cash is not a safe investment. It's enticing because it's not volatile, but he really recommends not being in cash basically at all right now. He's basically saying don't hold any cash. So since we can't be in cash right now because inflation is so high, he's saying that instead of being in cash, people should just be incredibly diversified. And we're going to take a look at Ray Dalio's portfolio later on here in the video, but Ray's portfolio is incredibly diversified. So instead of holding a bunch of cash right now, Ray is actually diversified not just across America, but across the global economy. He has ETFs, emerging market ETFs, and his money is just spread out all over the world. So he is very diversified. And to me, it looks like Ray is playing a very safe game right now. He doesn't look like he's taking on too much risk. He's actually kind of been criticized for this over the past year because Ray's returns haven't been anything amazing. He's been lagging the market quite a bit, actually. But Ray's goal right now isn't to maximize returns. If you listen to this to this interview, he says you can have upside while also mitigating your downside risk. And I think that Ray is basically saying that he thinks there's a lot of risk in the global economy right now. So he's trying to mitigate his downside risk. He's not positioned to capture a lot of the upside right now. He's positioned to really control his downside. And this guy is the largest hedge fund manager in the world. I mean, I think a lot of people are just trying to protect their downside by investing in his hedge fund, right? He clearly knows what he's doing. So yeah, I just think that it's kind of funny that people give him so much flack, especially in the past year, because his portfolio isn't outperforming the market when that's not even really his goal. But what Ray is trying to tell investors is that we should all have balanced portfolios. And what he said in the video is that when something happens, something else happens in the market. And obviously, right? But what he meant by this is that usually when something sells off, another asset is usually going up. So when you have a balanced portfolio, those things kind of weigh each other out. Like if this asset's being sold off, then your other asset is probably going up. And he said that there's a lot of relationships like this in the stock market. And I actually have an example right here of a stock that goes up when the overall market is being volatile and people are reducing their risk. This stock right here is Fortis Inc. And this is a Canadian utility company. And if we take a look right here from December 1st, it was worth about $55 a share Canadian, and it is now worth over $60 a share Canadian, and it actually hit an all-time high. So this stock has run about 10% in the last week. During all of this market volatility and all of the sell-offs that we're seeing on a lot of speculative growth stocks, this company is hitting all-time highs and it's up 10% in the last 2 weeks. So this is what Ray is talking about. You'll notice these relationships in the market where when certain assets are selling off, other assets are spiking and going up. And that's why when you have a balanced, diversified portfolio, when one thing goes down, another thing goes up. And Fortis is actually one of my biggest positions. So during this market volatility, this stock has been doing quite well for me. I'm pretty happy with this one. Also, for those of you who have been asking for Canadian tickers and stock unlock, they are coming very, very, very soon. I don't want to get everyone's hopes up, but I can confidently say that sometime next week, at least, we're going to have full-on Canadian tickers and stock unlock. If you haven't tried Stock Unlock yet, you can get a free 7-day trial, link in the description. This is a platform. I co-founded this platform. It's a stock analysis, education, and research platform. Check it out. Get a 7-day free trial in the description. It's freaking awesome. I love it. And yeah, just go check it out and play around. But yeah, Ray is really trying to preach to investors to diversify their portfolios right now and try to have a bunch of different assets. And then he also says that wealth isn't so much destroyed as it is transferred. Now, what he's saying by that, in my own opinion, is that wealth doesn't actually leave the stock market. Wealth just moves around within the stock market. So again, when one thing is selling off, that money is usually just being transferred over into some other form of asset, whether that be gold, utility stocks, dividend stocks, value stocks, growth stocks. Money is always just moving around in the market, and money isn't ever really leaving the market. I would actually say that with the Fed printing so much, there's a lot more money coming into the market, and then that money is just moving around within the market. So wealth isn't actually being destroyed, it's just moving around and it fluctuates. Now, personally, I'm going to give you guys my thoughts. I was going to wait till the end, but I just feel like doing it now. I honestly am not that diversified in my portfolio. I don't even own 20 stocks right now. Yeah, as like smaller retail investors, I actually don't know if it's really worth it to diversify that much. Like, I think having some ETFs, if you really want to diversify, is probably good enough. And then having a few high conviction stocks is probably also good enough. I don't think everyone needs to own Bitcoin, gold, ETFs, bonds, all that, especially us smaller retail investors. Now, as always, that is not financial advice. That is just my own opinion. That is just what I am doing. I don't own any bonds. I just own stocks. But if I had billions, then maybe I would do Ray's strategy here. But I'm not that diversified. That's that, because that would be an insane amount of diversification for me. Now, the last thing that I want to show you all is Ray Dalio's stock portfolio. The guy has 683 holdings right now, okay? That is insane. 683 holdings. But if we scroll down, we can take a look at Bridgewater's top 50 holdings. Bridgewater is the hedge fund that Ray Dalio manages, and we can see that his top holding is an ETF, the VWO, which makes up about 6.42% of his portfolio. And in the last quarter, he actually nearly doubled this position. Now next, he has EEM, which is another index fund. It's another emerging market index fund. He increased this position by nearly over 8x in the past quarter. And then his third largest position in his portfolio is another emerging market ETF. And it looks like he doubled his position in this one in the last quarter. So 6%, 5.5%, basically 12%, and then so basically about 14 to 15% of Ray Dalio's portfolio is in these emerging market ETFs. Now, I went and took a look at what's actually in these ETFs, and it's a lot of stocks in China, and a lot of stocks over in India, and a lot of stocks in Taiwan. These are, emerging markets, and they're very diversified over like Asia and other emerging markets around the world. So he is really diversifying himself in emerging markets, and that basically makes up 15% of his overall portfolio right now. Now, his fourth largest holding is the SPY ETF, which tracks the S&P 500, which now makes up 4.62% of his portfolio. So his top 4 holdings are all ETFs right now, and they make up about 20% of his portfolio. So about 1/5 of his portfolio is in these ETFs. Now, after the SPY ETF, he's got Walmart, Procter & Gamble, Alibaba, Johnson & Johnson, Coca-Cola, Pepsi, and the Gold Trust, and then at Costco. So what I am noticing about these holdings right here is that most of these are really strong American brands. I mean, again, Walmart. Everyone knows Walmart. Procter & Gamble, very household name. Johnson & Johnson, Coca-Cola, Pepsi, Costco. Those are very strong American brands. Now, why I think that Ray Dalio owns these very strong American brands is because Warren Buffett has said the best thing to own during high inflation is a strong brand. These are companies where, when inflation increases, they have the pricing they have the branding power to increase their prices with whatever inflation is doing. Like, think about a Coca-Cola. If I am craving a Coca-Cola and I want a Coca-Cola, I'm going to go buy a Coke. I don't care if it's 10, 20, or 30% more expensive. I'm probably still going to end up buying a Coke because it's a really strong brand. I want it, so I'm going to go out and buy it. So this is why these brands are attractive during inflation, because they can continue increasing their prices and consumers are most likely going to continue buying their products because they're household names And they're just really strong brands that people feel attached to and essentially just have habits buying. So these really strong American brands right here, I think Ray owns because we're in a very high inflationary time, and these are all brands that should do well during inflation. Now, Alibaba, it looks like he actually increased his position by more than double in the past quarter, makes up 2.67% of his portfolio right now. Alibaba's looking really cheap if you're bullish on China, and if you think that Alibaba is going to remain for the next 100 years, like that's their goal, then yeah, Alibaba's looking quite cheap right now. And then he also increased his gold holdings by about 48% in the last quarter as well. So it looks like he is starting to buy more gold too. But yeah, those are the top holdings in his portfolio. Again, it looks like he is diversifying quite a bit. That's what he's been up to. That's his top holdings. And yeah, that's my opinion on them. Just to quickly summarize what we covered in this video on Ray Dalio. Number one, he is saying that we are not going to market time this. Trying to time the market right now is an absolute fool's game. It's not worth it. It's not really going to lead to anything. So don't try and time the market. Number two, he is saying that cash is a pretty bad asset right now just due to inflation. He's pretty much recommending investors don't hold cash right now when inflation is this high, and he thinks that it's much better to have a well-diversified portfolio. And then we took a look at his portfolio, and his portfolio is in fact quite diversified. So those were the key takeaways that I took away from the video, but let me know what you all think down in the comment section below. Do you guys think that right now is a really good time to be holding cash with the market being so volatile and everything? Or what are your guys' strategies? I would love to hear what you're all up to, and yeah, let me know down in the comment section below. Also, if you enjoyed this video, then please remember to leave a like on it. It really helps out my channel, and I really appreciate it. And if you're someone who was interested in Stock Unlock, then the 7-day free trial is open. After the 7-day free trial, it is $6.99 a month, and we are continuing to build out a lot of features. Like, the platform isn't going to stop being built for a while, maybe even ever, who knows, right? But it's a really sweet platform. You can get a 7-day free trial by heading to stockunlock.com. Try it out risk-free. You don't need a credit card to try it out. And yeah, let me know what you think about Stock Unlock down in the comment section below. But that's going to wrap up the video, everyone. So thank you all so much for watching, and I really hope to see you all again in my next video.